Hello everyone and welcome to episode number 40 of JustDario Cigar Time. This week we have two big topics to talk about. The first one is going to be Powell's games of smoke and mirrors that jolted markets on Friday. But many people, in my opinion, really missed the true message that Jerome Powell delivered in his Jackson Hole speech. I'm going to provide you with an in-depth analysis of that and what that can mean for markets in the medium to long-term future. What that can mean to the economy, but especially what really transpired about the real thoughts going on within the Federal Reserve. In the second part, then, I'm going to focus on Nvidia because this coming week, the main event is going to be Nvidia's financial earnings release on the 27th of August, after US market close. And oh boy, the company really has a lot to explain about to its investors, because all that has happened so far in the past months really doesn't bode well for the business of the company, especially for its future expectations. So sit tight and stay with me till the end because you don't want to miss any of the important information I'm going to talk about today. Friday was such a great day for risk assets. It didn't take long for mainstream media to crank up headlines a few minutes after Jerome Powell's speech at Jackson Hole began. They didn't really bother to wait till the end and to convey the proper message that I believe Jerome Powell wanted to deliver to markets. Powell says Fed might need to cut rates. We'll proceed carefully. That was Reuters' headline. Powell indicates condition may warrant an interest rate cut, as Fed proceeds carefully, was CNBC's headline, and so many similar ones. Of course, stock trading algorithms loved it so much, and everything jumped. However, at the same time, something very interesting happened. While Jerome Powell continued to speak, we saw a jump in both risk-on assets and risk-off assets, with yields on US Treasuries going down and leading lower other major government bond markets that were still trading at that time. Hold on a second. Why were people bidding on risk assets and government bonds at the same time? Isn't this contradictory? Yeah, of course it is contradictory. And one more item that should have opened traders' eyes, but it didn't right away, was that while stocks were jumping and government bonds showed a risk-off move in the long-term part of the curve, then we saw gold and silver spiking quite a lot. The first one around 1% and the second one almost 3% on the day. Let me now summarize what happened on Friday. Jerome Powell signaled that the Federal Reserve is partially retreating from its inflation fight. The Fed will no longer aim for a 2% average inflation rate over time, which means the recent years of high inflation won't be balanced out by future below target inflation. Instead, they will simply work to bring inflation back down to 2% going forward. This policy shift was notably negative for the US dollar, causing a significant depreciation on Friday. The resulting jump in risk assets essentially offset the dollar's declining value, with these two forces counterbalancing each other. Ironically, while investors were celebrating, the actual purchasing power in their portfolio remained the same. Knee-jerk bid for government bonds following the Fed's message shouldn't have happened, but the negativity stemmed from Jerome's simple message that the economy is slowing significantly. What we saw on Friday wasn't a rational market reaction. Instead, traders across various asset classes simply cherry-picked what they wanted to hear from Jerome Powell. As people fully process Jerome Powell's Friday statements, you will notice risk on and risk off assets starting to move in specific direction going forward. I will now help you understand what will likely happen in the medium to long term based on Powell's perspective and information once the initial traders' euphoria subsides. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising, and if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. These were the exact words that Jerome Powell used on Friday. And clearly, many decided to ignore them. These words are very interesting because they point toward troubles in the labor market, acknowledging the huge revisions that the BLS delivered the previous weeks. However, they also acknowledge the importance of another very interesting dynamic that has been happening to a significant degree since COVID. The overall workforce participation rate not only never fully recovered from the sharp drop in 2020, but also remained in its long-term downward trend since the peak recorded in 2000. Let me be clear. This is not only happening in the US, but across the globe. It is a result of the so-called baby boomers generation heading into retirement in large numbers. This dynamic, combined with high immigration and very fat retirement accounts that even allowed many to retire earlier than planned, has contributed to a very tight labor market overall so far. At this point, the Federal Reserve struggle is somewhat easier to understand. On one side, they see younger generations struggling significantly in the job market, with now roughly 60% of university graduates in the past year still struggling to find their first job. The other side, because statistics, let's say, is a nasty beast, young generations' struggles are overcompensated by an opposite dynamic from an incredibly wealthy baby boomers generation that enjoyed decades of extremely loose monetary conditions and booming economies thanks to a zero interest rate policy environment to accumulate such an amount of wealth that they can retire comfortably and in larger numbers than young adults who enter the workforce. While the large wave of retirements should theoretically create many positions for younger generation, many of these jobs are instead being eliminated or outsourced to countries with cheaper labor costs. The Fed acknowledges problems in the labor market and potential downside risks, but ultimately it is forced by statistics to conclude that the overall labor market remains relatively healthy. This is why I believe that the Fed will eventually need to focus on specific segments of the labor market rather than viewing it holistically in the futures. As a matter of fact, if they stick to their broader approach, they won't have justification to ease monetary policy for quite some time, contrary to the current US administration's wishes. In his speech, how often did Jerome Powell mention employment-related terms? He said job 4 times, labor 21 times, and unemployment 12 times, totaling 37 mentions. Compare this to the word inflation, which he mentioned 63 times, almost twice as many. Given the Fed's dual mandate of maximum employment and price stability, what does this reveal about their true concerns? Are they generally worried about the labor market when inflation their message from beginning to end? No, they aren't. Inflation is objectively a more important focus for the Fed right now. Given this emphasis, which we will discuss in more detail shortly, I believe traders expecting a series of rate cuts are mistaken. Powell might go for a politically motivated rate cut in September, similar to last year's move, which aimed to pump stocks so the Kamala Harris campaign could take credit for it. That was a poorly conceived decision, as highlighted at that time in my article, Fed Action Today marks the beginning of the end of the fiat monetary system experiment. That unnecessary rate cut merely inflated the asset bubble, while long-term US rates continued climbing due to expanding deficit spending, government debt, and persistent high inflation. Before continuing with today's podcast, I would like to remind you the special offer that we have at Synax till the 30th of September to access 1 month free unparalleled stock market intelligence and then lock in a 1-year subscription for just $15. Back to our analysis now. Let's now shift to inflation, the real Fed's concern, starting with taking a look to what Jerome Powell said exactly on the matter. He said one very interesting phrase. The effect of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about timing and amount. Then, shortly after, he said, a reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. The Fed admits this inflation dynamic in the short term could risk workers seeing their purchasing power significantly decrease, leading to demands for higher wages. However, due to what they describe as a not-so-tight labor market, they currently see limited risk of this occurring. While tariffs will increase inflation, the Federal Reserve doesn't currently anticipate a price-wage spiral that will cause inflation to spiral out of control. They claim inflation and inflation expectations remain firmly anchored to their 2% target, a target that no longer represents an average 2% long-term inflation goal, as we discussed a few minutes ago. This assessment appears disconnected from reality. Prices have grown dramatically since 2020 and haven't been properly measured for years. Wages haven't kept pace with these real price increases for one simple reason. Consumers have relied heavily on financing options like buy now, pay later loans and credit cards, with balances now at record highs. All I'm describing reveals significant economic contradictions. While boomers are retiring comfortably because of rapidly inflating financial asset prices, oozing their retirement accounts, those remaining in the workforce, especially younger generations, struggle to make ends meet. Rather than demanding higher pay to combat inflation, many workers fear job outsourcing or replacement by immigrants if they speak up. This is why they would rather pile up on consumer debt to make ends meet, rather than risk losing their jobs altogether. Furthermore, because the shift signaled in the Fed's approach to its inflation goal, all the massive price growth added in recent years, well above its 2% target, will remain. It is easy to understand that a 2% increase on today's higher overall price level compared to a few years ago represents a significantly larger absolute increase. But the Fed has been very careful to deflect the public and traders' attention from that matter so far. Jerome Powell and the Fed are playing a sophisticated game of smoke and mirrors to hide reality while controlling market interest rates and inflation expectations. They understand that losing control of long-term yields could severely damage the stability of the global economy, governments, and particularly the financial system. However, this instability is already becoming evident in other major economies. Japan and the UK are experiencing record high long-term rates that continue climbing. Though Monday might bring temporary relief, similar to what US long-term rates saw on Friday, the overall trajectory remains upward. These countries demonstrate the path ahead as traders abandon long-term bonds as safe havens for preserving purchasing power due to out-of-control public deficit and government budget policies, instead favoring riskier assets like stocks. This shift is reinforced by volatility being suppressed to remarkably low levels. The VIX sits at just 14 despite an approaching economic slowdown. Even the Fed cannot refrain anymore from warning about. While gold and silver constitute a growing portion of investments, the fear of missing out and pressure to outpace inflation are driving investors toward high-risk, limited-reward asset allocations. In essence, the Federal Reserve ended up relying on inflation as a lever to support financial assets' inflated valuations. The reason why it cannot fight it according to its original mandate anymore. The middle class, on its side, shoulders the burden of these reckless monetary policies, supporting massive government spending and debt imbalances. Though statistics suggest prosperity on paper, this generation is, in real terms, among the poorest in modern times. They cannot afford homes, maintain emergency savings, or save for retirement because they struggle to make ends meet, drowning in consumer debt. It's absurd that stocks celebrate this situation, isn't it? The middle class won't indefinitely struggle to support a system benefiting only a few. And with baby boomers relying on inflated asset prices for retirement security, the situation becomes dangerous. If retirement accounts, heavily invested in stocks in the US in particular, collapse in value, these retirees will be forced back into the workforce. However, many jobs will have disappeared through automation or relocation by then, potentially causing a big spike in unemployment, likely made even worse by companies' aggressive cost control due to a weak economy. Meanwhile, inflation will continue rising because, let's never forget, inflation fundamentally is a monetary phenomenon. And if money printing continues, excess liquidity will carry on sloshing through the economy and into financial assets rather than abating because of an economic downturn. Without removing this excess liquidity, inflation will persist. In the worst case, developed large economies could face an inflationary depression similar to what happened to countries like Venezuela or Argentina. While policymakers persist in their attempts to inflate away their problems, this approach only works when the economy grows organically. When organic growth stalls, as it has been the case for years, inflation doesn't solve problems. It makes them exponentially worse. That's our current situation. I will now move on to the second part of what everyone will be watching this coming week, Nvidia earnings. Nvidia's earnings report is scheduled for the 27th of August, after US market close. Currently, the options market implies a move of plus or minus 7.5%. This is truly mind-boggling. How can a company already valued at more than $4 trillion potentially see its value shift by plus or minus $300 billion based on a single earnings report? How can a 600 billion variance in economic value occur in the blink of an eye? This is clearly absurd and merely the result of an extremely illiquid and speculative market that focuses so intensely on short-term movements that it has completely lost sight of true fundamentals. Fundamentals that are increasingly becoming a problem for Nvidia. The first major fundamental issue is Nvidia's mounting problem with China. After initially halting, then resuming, and now abruptly halting again H20's GPU's production, the company needs to explain to investors how it plans to compensate for $5 to $6 billion in lost revenues this year, along with billions of lost revenues in the future. impacting previous expectations shared with the market. Furthermore, now that China is explicitly demanding its national tech companies to switch to using local semiconductors in their infrastructure as soon as possible, and no, that order doesn't just refer to H20s, but to all kinds of GPUs Chinese tech companies purchased in one way or another from Nvidia during the years. How will Jensen Huang convince investors it can compensate for roughly one-third of Nvidia's revenue, both directly and indirectly related to Chinese buyers, that has now vanished? I have no idea how he'll manage this feat, but it wouldn't be the first time he's made seemingly unrealistic claims that investors embrace without scrutinizing the numbers. Nevertheless, the Chinese government has publicly recognized Nvidia's untrustworthiness and the risk of depending on them. Damage that, trust me, will be long-lasting. A clear warning sign to Nvidia investors has emerged this week with the release of the DeepSeek v3.1 open source model. This development shows China actively encouraging its companies to rapidly transition their AI infrastructure to local semiconductors, primarily from Huawei, with companies adapting quickly. This cutting-edge, cost-effective, high-performance model was trained using the UE8M0 data type, with the company stating through its WeChat account that UE8M0 FP8 is designed for the next generation of domestically produced chips to be released soon. Another overlooked fundamental development impacting Nvidia is the growing GPU's glut. Consider the recently ignored news about Meta signing a $10 billion agreement to rent GPU computing power from Google. This news should have raised the question, how is it possible Google has so much spare capacity if GPU demand is as overwhelming as Nvidia suggested? The fact that Google has enough spare capacity to rent to Meta clearly contradicts the narrative of extreme scarcity. CoreWeave Ponzi schemes presents another troubling case, as I have repeatedly warned for Nvidia. This company has siphoned capital through equity and debt to pay for GPUs upfront and inflate sales. Meanwhile, they have contracted to deliver computing power that is grossly excessive and unnecessary. OpenAI, effectively replacing Microsoft, remains CoreWeave's only real customer. Interesting, Nvidia itself serves as CoreWeave's second largest customer, while simultaneously acting as supplier and investor. Nvidia not only anchored CoreWeave's nearly failed IPO, but continued buying shares in the open market afterward, artificially inflating the price to extreme overvalued levels, as recently revealed through its latest SEC 13F filing. Why such a move? Because the narrative of growing data center demand generating immense need for GPUs is shaking significantly now that CoreWeave has revealed how unsustainable this business model is. The same situation is likely being experienced by other big tech companies, even though they have so far managed to hide it behind their strong legacy businesses. Look at the chart on screen now. This interesting comparison between OpenAI's GPT 4.5 model and DeepSeek's latest open source release shows greater performance at a fraction of the cost. It is now clear that the GPU computing power capacity built so far was mostly overhead. Hyperscalers accumulated excessive costs and unnecessary infrastructure, similar to telecom companies in the 2000s, as I noted in my article How Big Tech Spending Spree More and More Resembles 2000s Telecoms Epic Fail. Mainstream media has maintained a deafening silence about this issue. Why? Because if widely reported and acknowledged, companies like OpenAI and Anthropic, who claim they need hundreds of billions to build AI, would appear foolish. Their backers would look even worse for throwing enormous sums into inflated valuations, while actual outputs remain meager and promised revenues fail to materialize. The signs increasingly point to data center being a bubble that is now so big that especially the US economy can risk a severe impact in the moment it pops. Given these developments, Nvidia can no longer maintain the pretense that they'll continue selling GPUs in massive quantities. Furthermore, Nvidia's trustworthiness as a company is now in serious question, not only by China, but I believe by the US too. With the US government taking a 10% stake in Intel, while China fully backs Huawei, Nvidia is caught in the middle. Clearly, neither government fully trusts Nvidia, and perhaps they have discovered the extent of Jensen Huang's behind closed doors maneuvers to inflate Nvidia's value to astronomical heights. Actions that have been documented for so long that thinking about them makes me nauseous. Here is what I believe will happen this week. Nvidia will likely beat expectations again. Why not? They have dug themselves into such a deep hole that they cannot afford to pull the plug all of a sudden. That would be completely insane. They have already been fined twice by the SEC for cooking their books after the dot-com crash and the crypto miners crash of 2018. And this time they are cooking their books on such a massive scale that it could have serious consequences across markets, which is why they are clearly getting away with a lot. The regulatory system is turning a blind eye, but Nvidia still needs to be careful not to stretch reality too far. I think they'll deliver another beat, similar to how traders ignored 99% of Powell's speech and clung to the tiny bullish details they will find in Jensen Huang words. Jensen Huang will present his projections and the market might initially react positively. However, considering all the options built up around this event, market makers will try to maximize the number of options expiring out of the money, making themselves a huge profit. After Friday, we'll start seeing major players reveal their true thoughts about Nvidia, especially regarding Jensen Huang's promises that increasingly clash with reality. People ignore reality because stocks keep rising, making everyone feels like a genius. Similar to other companies that were eventually exposed, like Palantir or COREWEAVE, people might realize Nvidia was completely overvalued. No one should be surprised to see headlines in major media calling it the most overvalued stock of all time, opening Pandora's box on Nvidia as well in the near future. Evidence is objectively available, even if many people continue to ignore it. I believe they will try to ignore it once more, but scrutiny on Nvidia is increasing. Jensen Huang's promises and geopolitical maneuvering aren't backed by reality, quite the opposite. And the recent price action in Nvidia shows mounting skepticism already. This skepticism will turn into inquiry, and inquiry will turn into investigation. And then this enormous fraud will collapse, perhaps causing the biggest loss of value ever. I warn everyone to be careful in this environment and manage their portfolios accordingly. I repeat, I will never tell anyone to short a fraud or short sell anything, as it's one of the worst risk-rewarding trades in the markets. Unless your timing is perfect, you will lose more money more often than not, even if you're ultimately right. In cases of fraud, you could end up in serious trouble trying to short sell it. It is better to stay away from this massive cancer at the heart of the financial markets rather than trying to profit from it by taking unnecessary risks. Thanks a lot for listening again to my podcast today, for liking the video, for subscribing to my channel, for supporting me on X, and for reading and commenting my articles on JustDario.com. I wish all of you a nice week ahead.